This is your LMAX Exchange technical update for Wednesday, May 3rd, 2017. Euro dollar. So the outlook for the euro has clearly shifted over the past several days, with the market taking out the previous 2017 high and clearly showing signs of a major base, breaking out above 109 now and opening the door for fresh upside over the coming days and weeks, potentially all the way up towards the 114 area. At the same time, while we could see gains extend over the coming sessions, the risk for a pullback on a short-term basis should not be ruled out, especially with the market still wanting to fill that gap potentially that was seen the other week following that Monday gap open between the 107.30 and 109 area. We did fill some of that gap with the market trading down to as low as 108.20, but there is a gap now between roughly 107.30 and 108.20 of 90 points that likely would need to be filled before the market considers any meaningful continuation of gains. Of course, if the market breaks back above 110 now, there is risk that the market continues higher towards this 112 to 114 objective, but at the same time, it's worth being aware of the fact that the market could still pull back for a correction before heading higher. Overall, again, the structure is now constructive, so dips should be supported, but there is the possibility for dips down towards the 107.30 area for that next higher low and bullish continuation towards the 112 to 114 next topside objective. Only at this point back below, all the way back down below 105.70, that recent higher low that we saw back on the 10th of April, would compromise the constructive outlook for the euro. Sterling dollar. So cable has done a great job consolidating gains after breaking out above previous resistance at 127.75, which had defined the top of a multi-week range and a bearish consolidation off the plus 30-year low from October. The break above and sustained price action above that 27.75 level suggests indeed that the market is now forming a more constructive, legitimate longer-term base, and there is upside now towards 135, which is projected over the coming days and maybe weeks. But at the same time, this doesn't exclude or rule out the possibility for a short-term correction now to the downside. And if we do see additional upside, the market could face some significant resistance into the 130 area ahead of a possible correction. But any setbacks that we do see should be now well supported into the 125 area, with only a break now back below 23.60 to compromise the newly adopted constructive outlook for the pound. So again, on a medium-term basis, the structure is shifting. The market should be focused on a test of 135, but any setbacks that we do see that we are possible, that we should see potentially over the coming sessions, should be very well supported towards 125, with a higher low now sought out, and only back below 23.60 would compromise the constructive outlook. Dollar yen. So dollar yen has come up to finally take out some key resistance at 112.20, but as we've been saying in our analysis, it's going to be important to see how the market responds to 112.20 in the sense of whether it closes above or below that level. Despite the fact that we've broken above 112.20 on Tuesday, the market was unable to establish a daily close above 112.20, leaving the door open for the possibility of a topside failure up here and breakdown back towards a retest of the 2017 lows that were seen around 108.13, below which would expose what we've been talking about as a measured move objective at 107.60. So if the market again holds below 112.20 on a close basis, there is risk for another topside failure and fresh downside extension. If, on the other hand, the market establishes a daily close back above 112.20, that would take the immediate pressure off the downside and open the door for the possibility of more significant gains ahead. Euro Swiss. So Euro Swiss continues to be very well capped into rallies, with the market now stalling out ahead of some key resistance in the 109 area, which could be a lower top. At the same time, when the market has broken down to the downside, it hasn't been able to establish below 106, with that 2016 low at 106.24 proving to be a very tough support level to overcome. So right now, trading roughly between the 106.50 to 108.50 area, and a break on either end is going to be required for clearer directional insight. The market, though, while it is below 109, does favor the downside, and the downtrend here is intact while we hold below 109, with the risk for a resumption of declines now back towards the 106 area. Aussie dollar. So Aussie rallies continue to be very well capped, and a recent breakdown below the 75 barrier is opening the door for and suggesting fresh downside over the coming days, which could take us back towards medium-term support at 71.60. At this point, only a pushback above recent highs at 76.11 would take the immediate pressure off the downside. dollar CAD. So dollar CAD continues to extend its run to fresh 2017 highs, with the market most recently breaking above 137 and closing in on that next key objective on a measured move basis in the 140 area. The market is starting to look a little bit stretched, so if we do see pullbacks, they are possible, but those pullbacks should now be expected to be very well supported into the 134 area for a higher low and continuation of gains towards and through 140. At this point, only back below 132.24 would compromise the constructive outlook, but again, on a short-term basis, there is still risk for a bit of a short-term correction before the market continues higher. Kiwi dollar. So the New Zealand dollar continues to show signs of topping out after the market recently stalled out in 2017 ahead of 74. A lower top now looks to be in place at 70.90 by recent highs, and a breakdown back below some medium-term support at 68.62 would open the door for an acceleration towards next key medium-term support at 66.76 further down. Bear in mind that this is a weekly chart, which shows a better picture of where the market could be headed. And again, 70.90 is the key level to watch above, and only back above that level would put the pressure back on the top side. SPX 500. The S&P 500 has been consolidating over the past several days, though the latest bounce that we've seen does suggest the market could be wanting to push back to fresh record highs beyond 2400, opening the next measured move up towards the 2480 area further up. At this point, though, a break back below 2320 would be required to take the immediate pressure off the top side and suggest a more legitimate structural shift. Until then, again, this consolidation is classified as a bullish consolidation, which could open the door for fresh upside. Although the market is very extended on a longer term basis, we still would need to see a break back below 2320 to get the market thinking about a more significant structural shift. Gold. So despite the pullbacks that we're seeing in gold over the past several sessions, and although we still could see market setbacks extend over the coming sessions and the sessions ahead, the overall structure here is constructive since basing out in 2016 ahead of 1100, with the market putting in a series of higher lows and higher highs. And so this latest setback is viewed as corrective, with the next higher low sought out somewhere ideally ahead of 1215 in favor of a continuation of gains up towards what is now a measured move objective following a recent move that comes in at 1335, just shy of the 2016 high at 1375. Only back below 1195 would really compromise the constructive outlook for gold.